Tell us about what you're looking for in this report today, and is Standard Chartered still trapped in this emerging market story for banking analysts?
Yeah, I expect a continuation of a trend. So there's been the trend over the last 2 years. They've been growing a little too much and too fast over the previous 10 years, and then of course as it turned out to be not the kind of growth you wanted to have. They were they had a competitive advantage because all the American banks, they were dealing with the subprime legacy, but of course also once the Fed started the first round of QE, then bank of like Citigroup or JP Morgan became more important, especially in the Asian subsector, and then also began the problem of Standard Chartered. So we found out that they were too much concentrated in number of tickets, and therefore there's been the story of the bank. So cutting the exposure to commodities, mining, down to $40 billion, which is still higher than the common equity one, and we'll see what the outlook statement for the management is.
This is a bank that was building very strong presence across Asia and other emerging markets. When you have challenges of an economy across the region not being so strong, how cautious is a bank like this when issuing new loans?
Yeah, well, we found out in the case of Standard Chartered it wasn't very cautious because, as I said, that's what all the problem came to the fore. And then so we confirmed the old saying that you want to own the banks when they do the bad loans, but don't want to own the banks when they collect also the bad loans, because it's typically very difficult and they don't collect those loans at par value. Yeah.
Filippo, I want to ask you whether it's actually a decent buy at this point, because ever since the beginning of this year, bank bonds have got beaten up by lowered earnings expectations and the flood of fines imposed by regulators. And yet, you could get, what, 5% for most of these? I don't know, Standard Chartered is probably about 4.9 or something like that, but Deutsche Bank, you'll give you 5%. None of these banks are going to go out of business tomorrow. They've all been through ECB-driven stress testing processes. Can I climb the wall of worry here and safely put my money into a bank bond that's going to deliver me somewhat in excess of sovereign in Europe, or indeed anything I can get just by parking my cash in a deposit account? How safe is my money going to be if I buy bank bonds?
Yeah, actually, you have to distinguish between different banks, because there are some banks that still deliver quite a decent return. I believe also the negative interest rate, it's a little bit overstated in terms of the effect on the P&L of the banks. It does affect the banks, but from a credit perspective, so all those banks, as you said, the majority of those banks, they're not going to go into the wall. So in some cases, still we see some value. For example, in Europe, so we see value in banks like Barclays or Commerzbank. We like in Russia banks like Sberbank. We like. I think also a bank like HSBC is still which to us is favorite over Standard Chartered, not because David is here, but because I think also they've been a better risk management than Standard Chartered if you look over the long horizon. And I think also I would avoid some of the, we still like American banks, but would avoid some of European investment banks, which are still facing a lot of headwinds this year.